So this is the last section of Chapter 14, which deals with promissory notes. So we're going to learn to record the acceptance of a promissory or of a notes receivable. We're going to learn about account for the collection of the notes receivable and account for a dishonored note receivable. So there's a lot of new vocabulary words, again, both in the PowerPoint presentation and I highlighted them in our notes. But the main thing right here is a written and signed promise to pay a sum of money at a specified time is called a promissory note, or basically an IOU. A promissory note signed by a business and given to a creditor is entered in the business books as a notes payable. So it's basically like using a credit card, but you're not really using a credit card. You're just sort of making a promise to that business. Again, a lot of information for definitions here, but this is the parts of the promissory note and what each thing looks like. So it gives us every note's given a number and a date, the name and address. For the value received, the signer promises to pay 3 Green Products Incorporated. It gives them 90 days from the date, the principal sum of, and gives them an amount spelled out in words like on a check and what the interest rate would be, the maturity date or the date that it would be due, and then the maker of the note signs and the witness is there. Then there's going to be a journalizing the transaction and so forth that each of these slides will show us how to do. Again, if you're looking at the notes, I've highlighted all this for you. Sometimes it's easier to see it in the note format than on the slides, but either way, you have it in both ways. So I'm going to open up the Aplia problem here. And this is 14-3, work together problem. There's 3 steps. In the first step, we're going to do all the calculations, then journalize, then post. So for each of the notes signed by PLD Incorporated, we're going to complete the tables. So there's an ABC. The first part, we're going to, part A, the maturity date of the note. Then the second part, calculate the interest. And the third, the maturity value of that note. And then use the second table to do the total interest, the maturity date, and the total value. So in here, it gives us the notes, the dates due, the principal amount, the interest rate, and how many days. So the first one we're going to focus on is NR3. June 5th is the date for $20,000 balance. So here is the columns. So NR3 is what we're going to focus on. And we said it was June 5th. So what we have to do is figure out the terms of the note, the days that are remaining from the month. So it started out with 90 days. In June, you know, there's 30 days. So in here, we're going to put the dates of June the 5th through the 30th. So sorry about that. We know that it's the 5th through the 30th, so we know how many days that is. So from June 5th to June 30th, it's 25 days. So that's what they want in there. It's 25 days. So now, beginning with 90 days, we subtract the 25 days to find out how many days are remaining. So 90 minus 25 should be 65 days left. In July, we know there's 31 days, so we put the 31 there. We take the 65 days and we subtract the 31 for July, and the remaining here is 34. August, there's also 31 days. Same steps here, take the 34 that are remaining, subtract the 31 days in August, and we have 3. So that means we only have 3 left for September, so we're going to put the 3 here and get that down to 0. So this is just calculating the days remaining. Our interest then on this, we're going to start with that $20,000. Interest rate given above was 8%. And the days are the 90 days divided by the 360. That's how we would calculate that out. The maturity value then is the $20,000 plus the amount that we got from this formula here. So you're going to take your $20,000 multiplied by 8%, multiplied by the 90 over 360, and we get 400. And if we had to add these together, then the maturity value would be $20,400. From this information then that we just gathered right here from the calculations, we're going to scroll down here. And for this NR3, remember it's June 5th, $20,000 principal, 8%, 90 days. So from our information above then, our interest is $400 that we figured out. Our maturity date is that September 3rd. So we're going to type that in. And our maturity value is the total that we calculated, which was the $20,400. Now we have to do the same thing for this NR4, date June 12th, principal 10,000, interest rate 6%, and 120 days. So using that information, you're going to do each of these three boxes the same way, and then the information down below. So go ahead and try to do that, and I will put the answers in, and you can check your work. All right, let's see how you did. Again, we're on NR4 with this information given above. So we have 120 days to start with. June, it started on June 12th. We know there's 30 days. So between the 12th and the 30th, we know there's 18 days. So we put the 18 days here in the days from the month. Days remaining, we take the 120, we subtract 18, and we get 102. In July, there's 31 days. Subtract 31 from 102, get 71 for days remaining. August, there's 31 days. Subtract 31 from the 71 to get 40. September only has 30 days, so 40 minus 30 is 10. And then October, there'll be 10 remaining days to bring that to 0. In this box, we take the original amount of 10,000 that was given. It's at 6%, and it's 120 days for the note divided by the 360. And we do that math. In the third box, the maturity value, 10,000 plus the amount of interest, which is the 200 that we got when we did this math right here. So 10,200 is the full amount owed. Plug those numbers in down here then. So the June 12th, 10,000 principal, 6% interest for 120 days. The interest amount is 200 that we calculated from this math right here. October 10th is the mature date from this information that we gathered right here. And the maturity value is the 10,200 when we add those two numbers together. So now we go on to step 2, which is journalize the transactions. So we have 3 transactions to journalize. Chart of accounts for PLD Incorporated is there. Each of these sample transactions are, again, both in the notes and in the PowerPoint. And we have the directions here to journalize them as completed during July, page 7 of the general journal, page 8 of the cash receipts journal. And we have some new abbreviations. So notes receivable is NR, receipt is R, and memorandum is still M. So the first transaction, July 5th, accepted a 90-day 8% note from Gary Kinney for an extension of time on his account of $1,800, note receivable number 5. All right, so we'll go down to our general journal and put the 5th here. I'm not sure why they don't want us to put July here. I tried and it didn't let me, so I think we just put the date of the 5th. So notes receivable is now our debit, and our 5 is the document number for 1,800. The credit is accounts receivable / the person that owes us the money, Gary Kinney, for 1,800. All right, the second transaction, July 12th, received cash from Mary James for the maturity value NR1, which is a 60-day 9% note for $500, R113. So in order to find out the interest paid, we have to do that math. They're not going to give us that interest. So this thing gets in the way. Here it is right here. I tried to write it out. We take the $500, we multiply by 9% or 0.09, multiplied by 60 divided by 360, which is the 60-day note divided by 360 days, and we get $750. So we're going to need that amount when we scroll down to our cash receipts journal. This is what this transaction will look like. For December 12th, we are going to debit notes receivable for the original $500 in the general credit column. We are going to have the interest income of $7.50 from this math that we just did right here. We're going to add these two credits together, and we're going to get the full amount of cash that we're going to have coming, which is the $507.50. Adding up the 500 plus the 750. So this is the first type of transaction that we have in our cash receipts journal that will have a double entry, 2 lines for 1 entry here. So I'll leave this up here for a second, but notes receivable is the debit, interest income is the credit for the general, cash debit is those two added up, so our debits equal our credits. Third transaction for July is on the 26th. Dennis Kraft dishonored NR2 a 90-day 9% note for $400. So when we dishonor, it's a note that is not paid when it is due. So it is considered dishonored. So the math right here, the same type of math that we had to do from before. Get my pen out of the way here. Sorry. We start with the 400, we multiply by the percent given, which is the 9% note, and we multiply by the 90 days over the 360 or divided by the 360 to get the amount of $9. So this is the math that we have to do to figure out the amount of interest, which is the $9 of interest. So this is going to also go into the general journal. So if we scroll down here, here it is the 26th. This is going to be a 3-line entry this time. So we're going to debit accounts receivable Dennis Kraft. M25 is the document number for the full amount of $409. And we get that by adding the original note that was $400 plus the interest income that we just calculated of the $9. So we're going to credit the original notes receivable that was $400. We're going to credit the interest income of $9. We're going to add those together to get the $409 so that our debits equal our credits. So the last step is to post these journal entries. So the directions say to post the transactions in the general journal to the general ledgers and the accounts receivable ledgers when each transaction is journalized. So we're basically going to journalize like we always do. We're going to start with the general journal and then do the cash receipts journal. It also says the only entry required in the item column is balance when you are entering the beginning balance of the general ledger account. No other entries are valid. So we're going to go line by line. So we're going to start with July 5th for the notes receivable and post this to the debit account. Remember, the last step is to put the numbers into the post reference. They're in my answers now because I have the answer key open, but that's the last step. Whenever there's a double entry here, like the accounts receivable / Gary, we're going to have 2 numbers here to show that we posted both to both accounts in that credit of the $1,800. So I'm going to scroll down to each of the ledgers. The first one is the accounts receivable ledger for Dennis Kraft. This was the July 26th entry for from the general journal of $409 for the debit, and just carry that into the balance column. Gary Kinney, he had an original balance of $1,800. On July 5th, then we had a credit of $1,800, so that balances out to 0. And then the accounts receivable under the general ledger, we have 2, both from the general journal. The normal balance for accounts receivable is debit, so debits will increase it, credits will decrease it. So just make sure you have the correct numbers here in those columns. The notes receivable, it does have a balance of a debit as well, because that's money that we're receiving from somebody else on a note. So the beginning balance shows a debit balance. Any debits will increase, any credits will decrease. Interest income. This is interest gained because when we lend somebody money, we expect to get more in return due to the interest. This is a credit balance, so the balance is shown here. We had 2 transactions, one from each journal of interest, and the credits will increase that balance. So the ending balance for interest income is $474.50. Don't forget, again, the last steps is to always, after you post line by line, putting the numbers back into the journals, into the post-reference columns. So that concludes the work together for 14-3. There is 3 steps. Just make sure you're taking your time, pause the video as you're working along for the work together, and then go ahead and do the on your own problem.